All right, let's dive into the second quarter 2025 earnings for NexPoint Real Estate Finance, ticker INARF. Now, management came out calling it a strong quarter, but the market had a very different idea, sending the stock down almost 4% immediately. So what's the real story here? What did investors see that the headlines missed? Let's break it all down. So this is the central puzzle we're trying to solve today. You've got the company celebrating another strong quarter, but the stock gets hammered. That kind of disconnect between the official story and the market's reaction is exactly what we're here to unpack. What gives? To figure this out, we really have to look at two completely different stories. First up, we're going to look at the story the company wanted to tell, the one full of positive headlines and what looked like some pretty strong results. And that story kicks off with a really solid earnings beat. GAAP EPS came in at 54 cents. On the surface, that looks fantastic. I mean, for context, that's a huge leap from just 40 cents in the same quarter last year. So off to a great start, right? And the good news kept on coming. Their book value per share also ticked up about 1% to $17.40. Now, for a REIT, this is a really key metric. It basically means the stuff they own, their assets, are worth a little bit more. Any increase is a good sign. Okay, but this is where the picture starts to get a little bit fuzzy. This number, 0.92x, is their dividend coverage from something called cash available for distribution, or CAD. What it means is that for every dollar they paid out in dividends, they only actually generated about 92 cents in cash to cover it. Now that's close, but you can see why for investors who rely on that dividend, close might not be close enough.
But you wouldn't know there was any concern if you just listened to the management team. Despite that little coverage gap, their tone was super confident. They kept talking about their disciplined, opportunistic strategy, making it clear they felt they were navigating a really tough market better than anyone. Their message was simple: trust us, we've got this.
So how exactly are they planning to pull this off? Well, it all comes down to their portfolio. And take a look at this. It is a highly concentrated bet. Over 80% of their money is tied up in just two sectors: multifamily and life science. This is not your classic don't put all your eggs in one basket play. They've picked their baskets and they are going all in. And this really breaks down their thinking on those two big bets. For multifamily, they're basically playing the long game, saying, hey, the whole market is going to get better in a couple years, just be patient. But for life science, it's a totally different story. They're admitting, yeah, this sector is struggling, but they're betting the farm on one single project, Alewife, to be a massive home run for them. Okay, so that was management's story. Now let's flip the coin and look at the second story, the one investors were actually focused on. And this one isn't about the past. It's all about the future, the guidance, and some pretty serious headwinds. And to really get why the market got so nervous, we have to talk about CAD again. You see, unlike GAAP earnings, which can have all sorts of accounting adjustments, CAD is about the cold, hard cash. And when you're paying out a 50-cent dividend but only bringing in 46 cents in actual cash, well, people start asking tough questions about whether that dividend is sustainable. And check this out. This is their guidance for the next quarter. Look at that CAD per share line. The midpoint of their forecast. It's exactly 50 cents. They're literally drawing a line in the sand and telling Wall Street, we know we missed, but we promise we will exactly cover the dividend next quarter. Talk about putting the pressure on yourselves to execute. So let's just boil down what's really bugging investors. The cash flow wasn't enough to cover the dividend. And their whole plan to fix it relies entirely on things that haven't happened yet. They need to close on a huge pipeline of new deals, and they need to sign that massive, critical Alewife lease. In short, they're selling promises, and the market wants to see profits. Which brings us right back to that original question. Why the big drop? Well, the market's verdict was simple. It's choosing to value execution over optimism. It's a classic show me, don't just tell me situation. And boom. There's the verdict in visual form. A drop of nearly 4% on earnings day isn't just a blip, it's the market shouting its opinion. Investors heard the confident talk. They weighted against the numbers, and a lot of them decided to hit the sell button. And this quote right here just nails the entire sentiment. Talk is cheap, the market is in prove it mode. It's not going to reward the stock or re-rate it, as analysts say, until they see tangible proof. And that proof is higher cash flow and a signed, sealed, and delivered lease for that big, risky Alewife project. So, if prove it is the name of the game, what exactly does that proof look like? Let's talk about the key catalysts, the make or break items that every analyst is going to be watching like a hawk next quarter. All right, there are 4 huge things to keep your eyes on. Number 1, and this is the big one, the Alewife lease. Is it signed or not? It's that simple. Number 2, Q3 earnings. Did they actually hit that 50-cent CAD number they promised? Number 3, that big pipeline of new deals. Are they actually closing them and turning them into cash? And finally, number 4, the dividend itself. What's the tone? Do they sound confident? These 4 things are pretty much the entire story for this stock going forward. So with all of that on the table, what should we be expecting on the next earnings call? Here's our take. So for the results, we actually think they're going to hit their number. They'll report 50 cents in CAD, just like they guided, getting them to that 1.0x coverage mark. But, and this is a huge but, we don't think that's going to be enough to really move the stock. It's probably going to be stuck trading sideways, maybe between $14 and $16, until there's a formal, concrete announcement about the Alewife lease. The biggest risk here is any delay on that lease. That would confirm the market's fears and could easily send the stock right back down. So when you add all of that up, our rating for INRF is market perform. It's not a buy, it's not a sell, it's all wait and see.
And here's why. Simply put, you have this massive potential reward if that Alewife lease comes through, but it's balanced almost perfectly by the very real risk of delays or problems. It's the classic show me story, which leaves you as an investor with one critical question. In a market that's full of opportunities, is a company that needs you to wait for proof really the best place for your capital today?
This is not financial advice.